Hello, world, and welcome back to Boss Economic World. The only show that peels back the jargon-filled onion of global finance to reveal the juicy, sometimes tear-jerking, truth at its core. Today, we're hopping across the pond to good old Blighty, the United Kingdom, where the financial world is holding its breath for a decision that's got more drama than a season finale of The Crown. The date is November 3, 2025. And this coming Thursday, 9 individuals, collectively known as the Monetary Policy Committee, think of them as the UK's economic Avengers, or perhaps the Sinister Nine, depending on your mortgage rate, will gather in the hallowed halls of the Bank of England on Threadneedle Street. Their mission? To decide the fate of the nation's interest rate. For the past year and a bit, it's been a predictable affair. Since August 2024, the bank has been on a cutting spree, trimming rates like a nervous gardener every 3 months. It's been the financial equivalent of a scheduled haircut. But this time? Oh, this time is different. The clippers are hovering, the hands are shaking, and the market is whispering that for the first time in over a year, they might just stop. The current bank rate is sitting at a cool 4%. The question on everyone's lips, will they slice it down to 3.75%, or will they hold their nerve and keep it steady? Most of the so-called experts, the economists in their ivory towers, are betting on a hold. But it's going to be a nail-biter, a photo finish, a genuine toss-up. And at the center of it all is one man. Governor Andrew Bailey. The man with the weight of a 67 million person economy on his shoulders. He's the swing vote, the kingmaker, the Dumbledore of Downing Street's financial neighbor. As one analyst at TD Securities put it, the next BOE decision will hinge on the governor. No pressure, Andy. So, let's break this down. Why is this decision so agonizingly difficult? Why are the world's smartest financial minds split down the middle? To understand that, you have to understand the two-headed beast that is the 2025 British economy. Imagine you're driving a car. But this isn't just any car. It's the UK Economy Mobile. And you have one foot slammed on the accelerator and the other foot slammed on the brake. That, my friends, is the predicament facing the Bank of England. Let's start with the problem that's been giving central bankers nightmares for years: inflation. The bank's one sacred mission, its prime directive, is to keep inflation at a neat and tidy 2%. Where is it right now? It's running at 3.8%. Now, 3.8% might sound better than the terrifying double-digit figures we saw a few years back, and it is. But it's still nearly double the target. It means your weekly grocery bill is still noticeably higher than last year. The cost of a train ticket makes you wince. That pint at the pub feels less like a casual drink and more like a small investment. From a central banker's perspective, this is a 5-alarm fire. Their training, their instincts, their very reason for being, screams, hike rates. Or at the very least, don't you dare cut them. Cutting rates is like pouring gasoline on that fire. It makes borrowing cheaper, encourages spending, and pushes prices up even further. So, the inflation data is screaming hold. But here's the twist. While the inflation engine is running hot, the rest of the car is sputtering and showing signs of breaking down. The UK economy is, to put it mildly, feeling a bit poorly. Let's look at the evidence that's been piling up since their last meeting in September. 1. The jobs market is softening. That's a polite way of saying unemployment is ticking up. More people are looking for work, and companies are getting hesitant about hiring. Governor Bailey himself has voiced concerns about the economy running under potential. 2. Wages are cooling. Private sector pay growth, a key driver of inflation, has finally started to slow down. For a while, it looked like a dangerous wage price spiral was taking hold, where higher wages led to higher prices, which led to demands for even higher wages. That fever seems to be breaking. 3. Services inflation dropped. This one is huge. The services sector, think everything from haircuts and hotels to consulting and IT, is the backbone of the UK economy. In September, services inflation was expected to rise, but instead, it fell. This was a major downside surprise and a big piece of evidence for those who think the inflation dragon has been wounded. For business is gloomy. The CBI Industrial Trends Survey, a reliable pulse check on the manufacturing sector, showed orders are dropping off a cliff. Factory owners are looking at their order books and seeing tumbleweeds. 5. Shoppers are cautious. The British Retail Consortium reported that shop price inflation softened materially. Even food prices, the villain of the post-pandemic era, actually fell. This suggests that consumers are tightening their belts, and retailers are being forced to compete on price again. So, all this data is screaming cut. The economy needs a helping hand. A rate cut would make mortgages and business loans cheaper, injecting a bit of life back into the system, and maybe, just maybe, staving off a nasty recession. You see the problem? One set of data says hold. The other says cut. It's a classic head versus heart dilemma. And to make matters even more complicated, there's another player about to step onto the field. The government is set to announce its budget on November 26. And the rumor is, it's going to be a tough one, full of big tax rises to plug the holes in the public finances. If the government is about to take a load of money out of the economy through taxes, does the Bank of England really want to be keeping borrowing costs high at the same time? It's like kicking the economy when it's already down. This is why sane, rational people like Dan Hansen at Bloomberg Economics are saying a hold is more likely. The bank will want to know the contours of the budget before delivering further easing. It's like refusing to make your next move in a chess game until you see what your opponent is about to do. So, how does this impossible decision actually get made? It's not just Governor Bailey in a room by himself. It's a vote. 9 members, 9 votes. A simple majority wins. And this is where it gets really interesting. Because the MPC isn't a monolith. It's a collection of individuals with different philosophies, different fears, and different priorities. It's a game of thrones and suits, fought with economic models instead of swords. Let's meet the players and their likely allegiances. Team Dove, these are the members who are more worried about a recession than they are about inflation. They see the weak data and believe it's time to give the economy a shot in the arm. 1. Swati Dhingra, an external member from the London School of Economics. She's been the committee's most consistent Dove, arguing for months that policy is already too tight. She's a guaranteed vote for a cut. 2. Alan Taylor, another external member, a respected economic historian. He's also been on the dovish side. Expect him to join Dhingra in voting to cut to 3.75%. 3. Dave Ramsden, now here's a crucial one. Deputy Governor Ramsden is a bit of a swing player. He actually voted for a cut back in June, dissenting from the majority. If he sees the latest week data as confirmation of his earlier fears, he could easily make it a third vote for a cut. The consensus is that he'll join the Doves this time. So, that's 3 votes for a cut, almost certainly. Team Hawk, these members are haunted by the ghost of 1970s inflation. They look at 3.8% inflation and think the job is nowhere near done. A premature cut, in their eyes, could undo all the painful work of the last few years. 1. Catherine Mann, a former OECD chief economist. She is a known and feared hawk. She's more likely to be arguing for a rate hike than a cut. A solid, no doubt about it, vote to hold. 2. Megan Green, another external member, a prominent global economist. She replaced a very dovish member last year and immediately established her credentials as an inflation hawk. She's worried about inflation getting sticky. Another guaranteed hold. 3. Hu Pill, the bank's own chief economist. He's the intellectual heavyweight behind the bank's forecasts. He has tended to be on the cautious, hawkish side, emphasizing the need to see the job through. Bet on him voting to hold. 4. Claire Lombardelli, a deputy governor with a background in the Treasury. She's relatively new, but her voting record so far has aligned with the hawkish camp. She's expected to vote hold. That's 4 solid votes for holding the rate at 4%. So, the score is 4-3 in favor of a hold. It all comes down to the final 2 members. And who are they? The power couple, the governor and his deputy. 1. Sarah Breeden, deputy governor for financial stability. Since she joined the committee in November 2023, she has voted in lockstep with the governor at every single meeting. She is Bailey's most loyal lieutenant. Where he goes, she goes. 2. Andrew Bailey, the governor. The big boss. The entire decision rests on which side Bailey and Breeden decide to join. If they vote to hold, the final tally is 6-3. A comfortable, clear majority. If they shock the world and vote to cut, the tally is 5-4 for a cut, and markets go wild. So what is Andrew Bailey thinking? Trying to read his mind is a favorite parlor game in the City of London. He's a cautious man by nature. He's not a radical. He's a steady hand on the tiller kind of guy. Remember back in August? The committee was also split. To secure a clear majority, Bailey had to call an unprecedented revote because even the members who wanted to cut couldn't agree on how much to cut. It was a messy, awkward affair that showed just how divided they were. Bailey likes order. He likes consensus. His recent comments have been a masterpiece of central bank ambiguity. He's acknowledged the softening jobs market. He's talked about the economy running under potential. But, after the last meeting, he said markets were right to expect the bank to watch very carefully to see how the economy unfolds before whatever we do next. The most likely scenario is that Bailey looks at the high inflation number, looks at the upcoming budget, and decides that now is not the time for another move. As BNP Paribas economist Danny Stoilova says, he'll likely take the view that a few downside data surprises do not immediately make a trend. He will bring Sarah Breeden with him, join the 4 hawks, and the final vote will be 6-3 to hold rates at 4%. A close call, but a hold nonetheless. But wait, there's more. This meeting isn't just about the rate. The bank is also debuting a whole new way of communicating its decisions, an attempt to fix its notoriously terrible PR. For years, the bank's message has been as clear as mud. This time, they're trying something new. A majority forecast, instead of some weird best collective judgment forecast that nobody really owned, the new forecast will reflect the opinion of the majority who voted. This is huge. It gives a much clearer picture of what the winning side is thinking. Scenarios, they will introduce scenarios to explain how they might react to different risks. For example, if the budget is much tighter than expected, we might respond by. This gives the public and the markets a better guide to their reaction function. Individual explanations. For the first time, each of the 9 members will get their own paragraph in the minutes to explain their personal vote. This is a revolution in transparency. We get to hear directly from Team Hawk and Team Dove in their own words. It will be required reading for all of us BOE watchers. So, even if they hold rates, the commentary will be incredibly juicy. The new inflation and growth forecasts will tell us what the majority think will happen next. Most economists expect them to lower their inflation forecast for next year, but keep the growth forecast pretty much the same, stagnant. If, against the odds, they do cut, look for a big change in the official statement. They'll likely scrap the line about a gradual and careful approach and switch to a more non-committal, meeting by meeting, we'll do whatever the data tells us stance. So, there you have it. The Bank of England is trapped between a rock and a hard place. Trapped between stubborn inflation and a sputtering economy. The most likely outcome for Thursday is a hawkish hold. They'll keep rates at 4%, but the vote will be split, maybe 6-3 or even a super tight 5-4. Governor Bailey will play it safe, wanting to see the government's cards in the November 26th budget before he makes his next move. What does this mean for you? If you have a variable rate mortgage, a hold means no immediate relief. Your payments will stay high for a little longer. If you're a saver, good news. Your savings account will continue to earn a decent-ish return. If you're worried about your job, a hold is a signal that the bank is still more worried about inflation than a recession, which might make you a little nervous. The decision to pause isn't a decision to stop. If they hold in November, the pressure will be immense to cut in December. The market is already pricing in a 2/3 chance of a cut before Christmas. The great British rate debate is far from over. This week's decision is just the end of one chapter. The battle between the hawks and the doves, between fighting inflation and fostering growth, will continue to rage within the walls of the Bank of England. And we, at Boss Economic World, will be here to translate the minutes, decode the doublespeak, and tell you what it all really means. Until next time, stay cynical and stay solvent.